Okay.
All right. All right, it's recording, guys. Man, huge honor to have Gareth Soloway. Did I pronounce that properly, Gareth?
Yes, perfect. Thank you.
And yeah, just like when you got online there and with Kevin before I hit record, and the charting community, man, it's fun discovering new guys. You see them on interview, then you look at the work. Wow, they've been doing this like for 10 years, and they're pure TA guys. And then because I always inspire myself when I saw Kevin's work, I started like stealing his arcs, whatever technique he had. But it's not really stealing. I don't know. It's just like you take something and then you try to fiddle around with it, see if it fits.
Yeah, absolutely. And I think that's so important for everyone to hear, is that, you can take someone else's technique and then you can fine tune it yourself and actually make it fit your trading style even a little bit more. It just takes some back testing and some forward testing, but that's a great point.
So do you want to just introduce yourself, tell us a little bit about yourself and your background, just so that people who haven't come across you before, I know you're on Twitter and you've been on Twitter for a long time, but for those that don't know you?
Yeah, absolutely. So basically, I've been trading for 20 plus years now. It's been a long time, but it's been a process. I think everyone kind of thinks that they see me or they see other pros and they're like, oh, he must have been a genius when he first started and just made money. And that's really not the case. As a trader, we all have to take our lumps. We all have to learn our lessons. And I've certainly learned my lessons. We always talk about how if you're going to become a cardiologist or a doctor, you have to pay for that schooling. In trading, oftentimes you have to do the same thing. You either pay the market or you pay another smarter trader to teach you. One way or the other, you're always paying somehow. So that was me. I didn't really have anyone to follow early in my career. I got interested in trading in high school when we had kind of an investment challenge type thing where it was a fake 100,000 and they said, okay, go ahead and invest it. And it happened to be in the late 90s, mid to late 90s. And it was just amazing to me how, this is when the .coms were running and my account, my fake 100,000 went to 200,000 or whatever it was. And it blew me away. I mean, I came from a kind of a middle low income a family where we didn't have a whole lot. And all of a sudden this type of money was very addicting to me. And I said, all right, I gotta pursue this. This has to be something I go for. And so I did. Throughout college, I dabbled in trading. And then after college, I basically went into it almost right away full time. I worked 3 jobs to replenish my trading account. I only had about $10,000 back then. And needless to say, in the beginning, you're going to lose money, or at least I did. And I lost some, and then I'd work my jobs and I'd put more money in. I'd decide, I still remember vividly, do I want to eat lunch or dinner today? Because I didn't want to spend money on both. And that was just really the focus. And over the course of time, I started to get the hang of it. I started to see what worked and what didn't. The charts were everything to me. I found that when I went off my emotion or my guts, it was almost always wrong. If I looked at the chart, I would notice things that were correct. And that's really how it kind of came about. So In the Money Stocks, my company's been around now. We've been operating since 2007, so about 14 years.
Wow. That's inspiring stuff, man.
Thank you.
That's my biggest challenge is my emotions. I'm super emotional and I'm trading. It's like super dangerous.
Yeah. Yeah. And so this is just a side note on that, is that everyone deals with emotion, right? We're human beings. We have emotion. One of the things I find is that basically, if you have an over emotional response, what it usually tells you is your position size is too big, right? So for me, I like to start out with really small positions. I'm usually buying stocks that are collapsing. Like right now, I've been dabbling in the Chinese stocks that have been beaten down a little bit. I'm generally looking to short the indices, as I think the markets at some point are going to correct here. And I'm starting with very small positions so I don't accumulate too big of a position right off the bat and get over emotional, because emotion is always there, right? It's just if I'm going to invest my whole life savings in something, I'm going to even be emotional. So it's all about doing it small and kind of dipping your toe in the water. And then if it goes down a little bit, you just add a little bit more and slowly accumulate.
Nice. All right. Did you let's see your charting, Gareth. So Kevin could judge you severely if you do a mistake.
I'm always curious to see how other technical analysts sort of approach it. Really, I mean, a lot of what me and Patrick do is quite heavily influenced by this guy Stan Weinstein, of course.
Yeah, absolutely.
His methodology, and just as a meteorologist and a weather forecaster, and developing my own techniques, and delving into this book, I'm just thinking, yes, that's exactly what what he's saying there is exactly right. All this fear and greed and overcoming emotion, and exactly what you just said there. That's a huge part of it. So it's always fascinating to see different people's, because people do take slightly different approaches. It's different ways of looking at the same sort of the information. I mean, what you've pulled up there is a price chart, and the way people will represent that and kind of analyze it varies slightly from one person to another. So yeah, it'd be interesting to see what you have to say here.
Yeah, so this is a chart of the S&P 500, the SPY tracking ETF, and what you can see here is such a cool channel or triangle pattern that the market's been in, right? So the S&P had its low in 2020, that March low where everyone was panicking, and then you had the big move up, and the low there to this high creates the beginning portion of that triangle. Now, one of the things that I'm paying attention to here is that the market is coming to a head where these two lines are going to meet, and what that tells us is that the market's either going to have to break down or break out. All right, so you're coming up to a big move. Now, one of the things that's caught my eye is that 2 times prior, so only 2 times in the past year and a quarter, we've broken below on a daily closing basis here and here. And what's interesting about this is, notice you don't get a secondary close below. So something that I look for is what I call confirmation. The institutions are known for playing games with small investors, meaning that they'll make something look like it's going to happen and then they whip it the other way. What I've found is if you get 2 consecutive closes with the second one being lower, it basically takes out the odds, or it raises the probabilities that in this case it's a real breakdown versus a game. So one of the things I'm watching for here is if we start to dip below or above, do we get a second daily close below, in this case, that first daily close below that line? If that happens, then I think you actually have some sort of corrective move on the horizon, meaning something like a 10% type correction, maybe more, but I think it's hard to go out on a limb and say anything more than 10% right now. So I think, at least for me, that's something I'm keeping a close eye on. We haven't broken it, as you guys can see there very clearly. And I think it's important to just kind of keep an eye on that, but know something is coming, because as these lines come to an intersection, right, price is going to be forced out of that triangle pattern one way or the other.
And it's often the case, I think, just through kind of observing these events taking place over time, that if it turns out to be an upside breakout from that particular type of chart pattern, it can be pretty violent and pretty rapid and lead to I suppose it's a typical sort of blow off top sort of situation, isn't it, where it would launch upwards and then kind of come crashing back down through the apex of that triangle very often. So it's
that's 100% right. When you have upsloping trend lines like this, if you do get a breakout, it's usually what you referred to as a blow off top, which will be kind of that last gasp where it just wants to take out all the shorts, and then it will reverse. So even if we do pop above it, I do think inevitably you'll see it come back in.
Because in a way, looking at it from, sorry, Patrick, I was going to say, it's kind of unsustainable, isn't it? Because it's been rising for so long, rising, then it gets to the apex and it rises some more. It's almost sort of pushing things beyond, where they would naturally want to go, and you get that kind of blow off, energetic sort of move to the upside, and they can be really large. They can take place over a period of weeks, or it doesn't necessarily have to be over in a few days. It can actually take a while and go much higher, but ultimately gravity takes over.
That's absolutely right. Is that, markets can go up for long periods of time. We've seen that, but there will have to be a flush out. One of the amazing things is that you've basically had a 3% correction 6 times in a row on the S&P 500 over the last, I don't know if it's 3 or 6 months, but that's the most you've seen, which for a market is if you look historically, that's super, super unusual to only get a maximum of 3%. But what's happened is the Federal Reserve has really just ended up, creating this system where the market feels and market participants feel that there's always going to be a savior there, right? There's always someone there. If the markets fall, the Fed will step in. If the markets fall, the government will step in. And that's actually not a healthy thing for people to believe, right? I mean, it's like my children thinking that anytime they fall off something, I'm going to be there to catch them. Inevitably, I can't catch them all the time.
Man, what strikes me, man, you're on the daily chart. There's not a lot of candles left before we hit that apex.
No, it's coming up extremely quickly. So I mean, you'd probably say in this situation, you have another week maybe of trading in here at most, but that's it. And then something has to happen. And it would be interesting for me, and I haven't done this yet, but to look for key dates. I do a little cycle analysis and seeing if there's a cycle coming up over the next week or so that it could kind of mix with that same breakout or breakdown.
Do you have I have this type of market crash indicator where when I see, let's say, the US dollar, the gold silver ratio, and the VIX spike up, and if they start really crescendoing up, I feel like it could lead to a huge market sell-off. Is there something you're looking at to help you weigh the probabilities of this breaking down or breaking out?
Yeah, so there's definitely certain indicators I'll look at, and they could range from things like the margin, the amount of margin people are taking. The gold silver ratio is absolutely one of them as well that you want to pay attention to. But for me, it's the sentiment. Sentiment is such an important thing for the market, and when you get this scenario where you have so many people bullish, and then not only that, but they are literally, taking every government check they get, putting it right into the market, which is a lot of the meme stock craze that occurred. And then you have the margin being people are just leveraged to the hilt. It creates this scenario where if we see any sort of hiccup that we're not expecting, it really can create a bigger sell-off. And the thing with margin is that when people are leveraged to the hilt, if there's only a 5% sell-off, it can create margin calls that then catapult the market to a bigger sell-off, which then cascades to a bigger sell-off. And those are really things that concern me. I mean, if you look at the margin in the market 2007 or the late 90s, I mean, there are so many things, not just the margin, but the same things are occurring. I mean, if you compare the meme stocks to the .coms, right, or the SPACs, right, the SPACs that have been so popular that have quieted down recently, it's the same thing as the .com era in terms of psychology.
Do you look at the like a super interesting chart that we've as precious metals that I've been covering for a while? They're like the US dollar. Do you have any type of take on that there, where this could be it's a tough one, the US dollar, because it's been long. If you look at the huge long-term trend, it's down, but it's been known to spike up at these market volatility spikes there. So I'd be curious to see what's your take, and if we could add your take on the US dollar to our weight of evidence there and see if we're totally wrong about it. Because I'm a long-term bear, but it's on the short term, it is looking like in an uptrend there.
Yeah, so you can definitely see the pattern here is we've been dipping and then we've been floating up and then dipping and then recently we've floated up. So there's no doubt that if we get so the long-term view on the dollar, you have to be bearish, right? So if you have a 5-year outlook or a 10-year outlook, the amount of money being printed, the fact that the Fed can never fully raise interest rates, and in every crisis we see this, the Fed never gets interest rates back up to where they were prior. It's always a lower level. So this implies that maybe they'll get interest rates back to 2%, and then the next crisis will go to negative interest rates. I mean, who knows? But the amount of money that has to go into the system and continually will is just not a healthy thing for the dollar. And on the other side too, with the dollar, I do worry that the digital yuan, right? So we've heard that China's cracking down on Bitcoin. The reason they're cracking down on Bitcoin isn't because they dislike Bitcoin. It's because they want the digital yuan to be the future reserve currency of the world. Wow. All right. So they need to get Bitcoin. They want to push Bitcoin down to let their currency kind of take the lead here and eventually take that over. Now, the negative thing for the dollar, which people don't understand, is that every country in the world holds a massive store of dollars because it's the reserve currency, right? So they all have to keep it on essentially their balance sheets. If you start having the digital yuan take over, now there's not a need to hold as many dollars anymore. So you have all these central banks and governments starting to dump dollars on the open market, which will then push the dollar lower. Now that's the long-term view, right? So if we take the shorter-term view, there's no doubt that on this chart, there is short-term momentum. You have a potential W pattern. So I wouldn't be shocked to see the dollar go a little bit higher in the near term. But keep in mind, the reason for that in the short term would be maybe a market sell-off. So if people start getting concerned about the markets start collapsing, you then can get a scenario where people rush into the dollar in the short term and buoy it up. So I think short term may be bullish. Longer term is not a pretty picture for the dollar, for me at least,
Yeah, well, you're just confirming my bias, so you're not helping me.
Sorry.
I'm
Sorry.
kidding, Gareth. But I didn't know about the digital one. That's where I miss like the fundamental stuff. Like I'm still in my charts,
Mhm.
but so you do scope out to these big macro themes, right? Which could have an impact.
Yeah, you know, you just want to be aware of it, right? So I 90% rely on the charts, but I don't want to keep my head in the sand, so I'm not paying attention to other things, especially the fundamentals are something. So in the shorter term, right, the technicals are everything. So when I swing trade, I'm looking at charts purely. You know, this stock is hitting a double bottom or a gap fill. That's going to create a bounce potentially. But when we look at like a longer term picture, I think it's important to see what other countries, especially a country as powerful as China, is looking to do for sure.
It's weird, Kevin, when you're talking about the yields that he can't go up. I was thinking about your chart because Kevin always has this kind of mind puzzle block. He says, how the hell could they raise the rates? Like the rates want to go up on the charts, they want to break out, but and then there's like the chicken or the egg or whatever. Like,
Right.
So the 10-year yield has been in a descending channel for the last, I don't know how many decades it's been, since the 1980s. And each time the 10-year yield tries to break up and break out of that bullish descending pattern, it gets knocked back down again. And my theory, I mean, the way I sort of see it and perceive it is that the reason for this, of course, is that interest rates always have to be on a downward trend because of the ever increasing debt burden of the United States. I mean, we're up to, what is it, 30 trillion, and that's not taking into account all the unfunded stuff.
Yep.
So as that debt burden increases at an ever increasing rate, then the rate of interest that can be afforded on that debt is ever decreasing. So every time that chart wants to break out, the point at which pain is reached, where the US is unable to kind of mathematically start to meet its obligations, that is coming down all the time. And it was at about, I think, 2.5 or 3% a few years ago. But looking at the debt now and the way it's, you know, sort of added, I don't know, maybe 10 trillion since then, that kind of level of interest that is affordable on those government yields is, you know, the 10-year Treasury note, for example, is lower. So we're going to find out, aren't we? You know, if we're in a situation where it's going to be prudent to raise rates to try and control inflation, we're going to see exactly how far it can go before there's a problem. And I wouldn't mind betting that it's not going to be anywhere near 2.5 or 3%.
Yeah, and I think you're right. I mean, it's so there's two scenarios here, right? One is that the Federal Reserve, in theory, can always keep control. Now, if they can keep control, you're right. To pay off the ever-growing debt, you need to have interest rates low. My one caveat to that would be is where does the system break, right? Where do we get to a point where foreign governments stop buying anything of ours in terms of debt because they're just seeing the writing on the wall of the dollar devaluing, the printing of money ever keep going. And at that point, can the Federal Reserve fight the natural market of pushing up interest rates? And honestly, I'm not 100% sure on that. I mean, I think inevitably the system is going to break and interest rates are going to do what they want to do. But the Fed is certainly going to fight tooth and nail to keep control and make sure that things can be paid off, you know, according to low interest rates.
yeah, we've seen that because sometimes we don't. People look at, they'll say even some people, they think like the 10-year chart is a lot of data, but if you look at let's say the interest rates 40, 50 years, you'll see that there was a period before the 1970s where I think there was yield control, like after World War II or something, and you see the interest rates that went down, they flatlined, but eventually I don't know, they just went back up. I don't know what was in the newspaper headlines back in the 50s or 60s before all that stuff. Maybe people saying, there's no way the interest rates could go up. And I don't know, history just feels stretched far enough, these cycles, that we forget that all this has happened previously in the past.
Yeah,
But
and
we
you're
didn't
right.
have
I mean,
yeah.
you're 100% right on that. Is history tends to repeat. I mean, if it doesn't repeat exactly, it's pretty darn close. And you also have to wonder if what happened in the 40s with World War II and after the 40s, did that influence then what we saw in the 70s and 80s in terms of interest rates? I mean, you got to think that it might all be connected in many ways. So that tells us that maybe in, you know, let's say the 2007, so could it be like, you know, where the yields were really low and then even lower now, maybe by 2040 or something, that's when we see interest rates in the 15% range. I don't know. But you're right. I mean, just looking back at history can teach us so much about what could happen. the question is always timing, right? And that's the hardest thing for me to predict, is that, when does it all come down? The house of cards is there. We know that it's kind of funny money that we're playing with at this point, but I don't know specifically to the month or even the year when the whole system comes apart.
What? I mean, you can't answer that question?
Yeah.
This is the 10-year yield I've got on the screen at the moment there, Gareth, and you can see what I was describing there. It's just in a continual downtrend ever since the 1980s. Every time it tries to go up, it's pushed back down, tries to go up, push back down, up, down. But the trend, every time it reaches a high point, is lower than the previous high point, and we're all the way down here now. And it tried to break out back here. This is technically, this is a bullish descending wedge. It's wider at the top than it is at the bottom here. This is a non-log scale, by the way. This is just a linear scale, which is fair enough because we're not moving logarithmically. So it being a little bit narrow at the bottom, this is a bullish chart pattern. It wants to break to the upside. It can't just go on and on to minus 50 and minus 100. It's just not, it's not possible. So the laws of nature, if you like, are wanting this to break out to the upside and pull it up, but it was pushed back down again here in 2018. It got up to around about 3%. There was obviously trouble there. There's a problem at 3%, and it was forced back down. Now, we've tried to break out again in this area here around just above 1.5%, I think it was, and it's it's being pushed back down again now. So it feels to me as though the pain point is significantly lower, because we've gone from whatever it was, 14, 15, 18 trillion of debt. We're up at 30 trillion of debt. So whatever we've added, 10 trillion or more, whatever it's been, it's having an effect. And the effect is that the rate of interest that is affordable is ever lower. And as you said, how can this be? This isn't sustainable. But the question, I suppose, is how long can it carry on before?
Yeah, and that pattern, that pattern is almost the perfect inversion of what I showed you guys on the S&P right now, right? So I mean, it's going to be interesting, because we're asking the same thing. Well, that those two lines are coming together more and more. When does the S&P break to the downside through that? And same here, when do the 10-year yields break to the upside and actually hold and really break out? And then my guess is, if it really does break out, it's going to get nasty, because you're right. There are so many issues here, right? You have inflation now that we really are starting to worry about. The Fed says it's transitory. I think you'll see a pullback in inflation. We've already seen lumber prices come in and oil starting to come in, but I don't think you're going back to 2% inflation like the Fed wants. And the question is, with labor costs, we all know that, just to get people to work for companies, you're having to pay them a lot more. That's their biggest input, right? So their biggest input of cost is now shooting through the roof, which is they're going to have to pass along eventually to consumers, which is going to create more inflation as well. So, again, I feel like you're on the term thin ice, right? And it's starting to crack all around us. And the question is, when do we just fall through into the freezing cold water?
Wow.
Yeah, it's a thought, isn't it?
Yeah. And I hate, by the way, being so there's always money to be made on the long side in certain avenues. Like just to be clear, like I mentioned, I'm starting to dabble in the Chinese stocks on the long side, and I have like Viacom on the long side as one of my positions, and I like gold. I like gold overall, even though interest rates going up tends to hurt gold. I do think once inflation is the culprit of higher interest rates, then gold will actually start to outperform. So to be clear, it's not doom and gloom. There's always places to make money.
Yeah, I mean, the inflation gold thing, it's something that more recently we've come to sort of be accustomed to, as you say, inflation not being that great for gold. But of course, look at the 1970s and what did gold do during an inflationary period there. So it's all to do with what the background factors are, and what the macro environment is that's causing the issues, and gold will react accordingly. And you have to look back more than just 10 or 20 years to kind of get all of your evidence on that. Right. The 1960s and 1970s could well turn out to be quite a good analog for what we might be about to walk into.
Mm-hmm. Man, I don't know, Gareth. I think we're going to have to do this again there, because I think we just scratched the surface. And like some people, Patrick, your interviews are too long, but man, because we're chart geeks. Like, yeah. I'm pretty sure we could talk about this for hours.
One quick thing, I know people. You did mention, Gareth, that you look at Bitcoin as well, yeah. And I know some of the viewers and listeners will be just keen to know what your immediate thoughts are on Bitcoin, because it's it's been interesting, hasn't it? Up to 65,000, down to around about 30,000, and we're back to, last time I looked, we're breaking above 41, 42,000, that sort of area.
Yeah. And I'm glad you brought this up because people do want to know the update. So this is your trend line. So we've been in a range on Bitcoin since, really April, May-ish kind of period when we dipped to that 30,000 handle. And then what you see here is we dipped below, then they reversed it. So the same kind of thing I'm watching on Bitcoin here is we are above that key level now. So watch to see if the next trading day, meaning tomorrow, can we continue up? If it does occur, then you actually have upside to about the 48 to 50,000 level. So ultimately, I do think that Bitcoin's going to come in later on, but don't think that it can't go to 50,000 before it does. The theory, or at least my thought process for why Bitcoin is going to eventually come into about 20,000 is just that there's going to be a deleveraging in the system, and it's probably going to coincide with the stock market at the same time. Just what we were talking about with margin calls and so forth. When you get a margin call in your stock account, you sell a little Bitcoin to cover it, and vice versa. And we've seen that correlation in the stock market as well as with Bitcoin before. Eventually, I think Bitcoin's 100,000, 500,000 and beyond. But again, you have to get this washout in the system at some point. There's just it hasn't washed out to the point where you see it enough yet. And that makes me think, again, even if it does go to 50, you're still going to be looking for a move back to about the 20,000 level. And again, remember, historically, Bitcoin has had 85% correction. So that would even put it below 20,000. But that's been a norm for Bitcoin over and over again.
Yeah. So always worth remembering that. Sounds scary, an 85% correction, but as long as you're on the right side of all of these moves, then it's not so much of a problem. It's just watching.
Yeah, and I think also just keep in mind, the long-term prospects for Bitcoin are really good. So if you're really just saying I'm not even going to pay attention for 10 or 20 years, you don't even have to worry about it. It's just just understand that you're going to have these dips in Bitcoin. It's just a very volatile asset because it's such a new asset.
Yeah, makes sense. Wise words.
All
wow,
right, Gareth.
As Patrick said, we're going to have to do this all again at some point.
Yeah.
Could talk
why don't we call this part one?
Yeah,
part one sounds good.
Sounds great, Gareth. Hey, I was super happy to meet you virtually for the first time. So I'll keep a track of stuff there that you do on Twitter there. It's gonna be a lot of fun. I can't wait for the next few days now that because of that SPX chart you showed me, man. I'm expecting something.
Yeah, let's see. If it does play out, let's get together in a week or two and let's definitely talk about it. And by the way, you guys are great hosts, and I love the fact that you guys actually know a lot of this stuff, and instead of just talking to someone who doesn't know a lot of the charts, and it makes for much more interesting interviews. So I appreciate that.
Yeah, well, sorry, Kev. It was kind of the goal of this podcast is we didn't want to interview just the person we had on had to have some knowledge of charts or had could talk a bit about it, but we just don't want to ask a question and let the guy ramble on for half an hour.
Yeah,
like the added value. It's guys with the other podcast, that's fine. But I think for our viewers, people who want a little bit of interaction between chartists, I think this was awesome.
Yeah, they want some meat and potatoes. Absolutely.
It's about collaboration, and different people have slightly different slants and slightly different views, and that's all great because pulling together all these pieces of evidence. You're not going to get everybody having exactly the same view, and that's no reason to fall out with somebody just because they have a different view to yourself. You have to take all of this into consideration and weigh it up as part of the weight of evidence, as me and Patrick always refer to it as. So that's fantastic. Gareth Soloway from inthemoneystocks.com.
Yeah. We'll put out, guys, go sign up to his website. We're going to put everything in the description. The guys that do like that, I can't believe I'm doing this. Go below, guys, in the description and subscribe. Hit the notification button.
Down there.
And also, yeah, follow me on Twitter. It's the free information is cool. Usually a good way to get introduced to what I do.
Perfect. Ciao, Gareth. Thank you very much.
Thank you, guys. Wonderful being here.